Ever find yourself wondering how people, without a lucky lottery ticket or a hefty inheritance, actually build real wealth?
Yeah, it's a common question.
Today, we're diving into a potential roadmap drawn from the personal experience of someone who, well, did just that through smart investing.
Exactly. We've got our hands on this really interesting article titled Investing for Beginners: How I Made Millions Through Smart Investing.
Right.
It's a very down-to-earth account by an individual who apparently started from scratch and achieved significant financial success in the market.
And that's what grabbed our attention, really.
Yeah.
Our goal with this deep dive is to extract the practical step-by-step wisdom from this person's journey.
Mm.
We want to uncover the core principles they live by so you, our listener, can maybe start applying them to your own financial aspirations.
Yeah, and it's important to stress this isn't about those get-rich-quick schemes.
Definitely not. This is about building something lasting.
Absolutely. And the article kicks off with a point that's, well, it's easy to overlook, but completely fundamental: the right mindset.
Okay, the mindset. Let's unpack that a bit.
Yeah.
Because I think a lot of us get impatient. We see stories, maybe online, of overnight successes and wonder why it's not happening for us.
Right. Impatience is a killer in investing.
But this article really emphasizes consistency, patience, staying the course, and a willingness to constantly learn. Is that right?
Precisely. The author points out that many beginners get discouraged because they don't see immediate huge returns.
Yeah, that makes sense.
But think of it like planting a tree. You don't expect, fruit the next day. It takes time, nurturing, consistent effort.
Good analogy.
They use a great line, something like, "Small, smart decisions made over time can result in massive gains." It's that slow and steady wins the race idea, but for your finances.
It's that incredible power of compounding we hear about. Not just for the money, I guess, but for your knowledge and confidence, too.
Exactly. Builds over time.
Now, before this author even thought about picking a single stock, they made education a top priority. That seems key.
Oh, absolutely crucial. And what's really stressed is learning before you put any real money on the line.
Right.
The article details the core concepts the author dove into first: understanding the basics of stocks, bonds, mutual funds, ETFs,
The building blocks.
grasping how compound interest works, its magic, plus, the fundamental trade-off between risk and potential reward. You have to understand that.
And they weren't suggesting, like, going back for a finance degree or anything.
No, not at all.
The article specifically highlights accessible, often free resources, YouTube channels, insightful blogs, podcasts, maybe like this one.
Exactly, those kinds of resources. And for those wanting to go a bit deeper, they do recommend some really foundational books.
Oh, yeah. Which ones?
The Intelligent Investor by Benjamin Graham,
A classic.
Rich Dad, Poor Dad by Robert Kiyosaki, and Common Stocks and Uncommon Profits by Philip Fisher.
Okay, so some heavy hitters there.
Yeah, they offer different but really valuable perspectives on investing and building wealth. They've kind of stood the test of time.
So, okay, armed with this solid base of knowledge, where did our author actually take their first investing steps? It wasn't jumping straight into, like, risky tech stocks.
No, definitely not. Their initial approach was very strategic and very beginner-friendly. They started with something called a systematic investment plan, or SIP.
SIP.
In a mutual fund, putting in just $1,000 each month, that's a really accessible entry point for almost anyone.
Okay, for anyone listening who's new to this, can you quickly break down what an SIP is and why starting that way can be, a smart move?
Sure. So a SIPP is basically like setting up a recurring payment, an automatic transfer, to invest a fixed amount at regular intervals, usually monthly.
Right, like a direct debit.
Exactly. And this allows you to benefit from something called rupee cost averaging, or dollar cost averaging, depending on where you are.
Okay, how does that work?
Well, think of it this way. When the market is down, your fixed amount, say, that 1,000 buys more units of the mutual fund.
Because they're cheaper.
Right. And when the market is up, that same euro 1,000 buys fewer units because they're more expensive.
Got it.
So over the long term, this helps to smooth out the average price you pay per unit. You're not trying to guess the perfect time to buy.
Remove some of the emotion and timing guesswork.
Exactly. And the author mentioned that doing this consistently for a decade laid a really solid foundation for their future investing.
10 years. Wow, that might sound like a long commitment to some, but it really drives home that point about needing a long-term perspective, doesn't it?
It really does. Patience is key.
Now, as they gain confidence and experience, the author then ventured into the world of individual stocks. That can feel like a much bigger, maybe scarier step for many?
It definitely can feel that way. But the article describes a very considered, methodical approach. They weren't just picking stocks based on the latest buzz or, a tip from a friend.
We're chasing hype.
No. They looked for companies with what they considered strong fundamentals. Things like a history of making consistent profits,
Hmm.
not being burdened by excessive debt, and having clear potential for growth over the long haul. Solid businesses.
And they even shared some examples, right? Reliable businesses they invested in.
Yeah, they mentioned TCS, Infosys, and HDFC Bank. These aren't, speculative fly-by-night operations.
Right, established companies.
Exactly. And what's crucial, really crucial here, is that the author explicitly said they didn't follow hot tips.
That's important.
It really reinforces the importance of doing your own homework, making informed decisions based on your own understanding rather than chasing these fleeting trends that can often be, well, pretty risky.
Makes sense. Understand what you own. Now, beyond just buying and holding shares in these companies, there was another simple yet kind of powerful habit that significantly boosted their portfolio:
Ah, yes.
reinvesting dividends. This might seem like a small detail, but it can have a huge impact over time, can't it?
Oh, it's remarkably effective. So when a company you hold shares in makes a profit, they might distribute some of that profit to shareholders as dividends.
Like a little cash payout.
Exactly. And you have a choice. Take that cash and spend it, or use it to buy more shares of the same company.
Okay.
By reinvesting, those extra shares you just bought also start earning dividends in the future. And then those dividends can be reinvested again.
The snowball effect.
It's exactly that. It's a snowball effect where your returns start earning their own returns. It really accelerates your wealth growth, especially over many years.
So instead of treating that dividend like a little bonus to spend, it became another engine fueling the growth. That makes perfect sense.
Compounding in action.
Another really key point the article emphasizes, and this is something so many beginners, maybe even experienced investors, struggle with, is the idea of time in the market, not timing the market.
Yes, that's a huge one. It's so tempting, isn't it?
Yeah.
To try and predict when the market will go up or down.
Totally. Buy low, sell high sounds easy.
Sounds easy, incredibly hard to do consistently. But the author's experience suggests a much more reliable strategy. Just stay invested.
Yeah.
Consistently, through the ups and the downs.
Even the scary downs.
Especially then, maybe. They apparently viewed market downturns not as a reason to panic sell, but as opportunities to buy good stocks, those solid companies we talked about, at a lower price.
Okay, that takes some nerve, though.
It does, but it's based on the historical trend highlighted in the article. Markets, while they jump around in the short term, tend to recover and trend upwards over the long term.
Right. So those who bail out during a dip essentially lock in their losses.
Exactly.
While those who stay invested or even buy more are positioned to benefit when things inevitably bounce back.
Precisely. And a crucial element in being able to mentally and financially weather those market fluctuations is diversification.
The old don't put all your eggs in one basket advice.
That's basically it, yeah. Spreading your investments across different types of assets.
And the author mentions a pretty broad range they invested in, didn't they?
They did. They diversified across equities, which are stocks,
Right.
mutual funds, index funds, gold, ETFs, real estate, and even dipped into international stocks.
Wow. Quite a mix.
Yeah, and the idea here is that different types of investments tend to perform differently under various market conditions. So if one area, say stocks, is struggling for a bit, maybe bonds or real estate are doing okay.
So it cushions the blows.
Exactly. It helps to cushion your overall portfolio and smooth out the ride. Think of it like having different shock absorbers for different bumps in the road.
Good way to put it.
Hmm.
Now, managing all these different investments, tracking them, it might sound a bit overwhelming. But the author also highlights some really practical steps they took to keep things efficient.
Yeah, they weren't just buying stuff randomly. They mentioned automating their investments where possible.
Like the SIPs we talked about.
Exactly. Setting up automated SIPs is a fantastic way to ensure that consistency without having to actively remember to invest each month. It takes the emotion and procrastination out of it.
Takes willpower out of the equation.
Right. And they also mentioned using tools, simple tools even, like Excel spreadsheets or dedicated investment apps. They mentioned ZeroToCoin, Grow, Kuvera as examples, to track how their investments were performing, understand their overall asset allocation, how much is in stocks versus bonds, etc., and make informed decisions about rebalancing if needed.
Rebalancing meaning.
Just, if stocks have done really well and now make up too much of your portfolio according to your plan, you might sell a little and buy more bonds to get back to your target mix. Keeps risk in check.
Got it. So it's not about being glued to your screen every single day, but having a system to stay informed and make adjustments, maybe quarterly or annually.
Exactly that. Stay informed, manage effectively, but don't obsess.
Now, the article also provides some really valuable warnings, highlighting common mistakes that beginners, especially, should really try to steer clear of.
Yes, these are the classic pitfalls. Things that can really derail your investment journey before it even gets going properly.
Like what?
Well, the author specifically warns against chasing those hot stocks, the ones getting all the hype.
The meme stocks, maybe.
Could be. Stocks that might not have solid long-term prospects but are just, flavor of the month. Very risky.
Okay. What else?
They also caution against panic selling when the market inevitably dips, which we've already touched on. Hold your nerve.
Right. Stay the course.
Another big one. Investing with borrowed money.
Yeah.
Leverage. That can seriously amplify your risks.
Yeah.
If things go wrong, you're in deep trouble.
Yeah, definitely avoid that.
And finally, and this is so important, they strongly advise against investing in anything you don't truly understand.
If you can't explain it simply.
You probably shouldn't be putting your money into it. It's easy to get caught up in FOMO, the fear of missing out. But understanding what you're investing in is absolutely crucial for making rational, long-term decisions.
Couldn't agree more. And the article, it wraps up with a really encouraging message, doesn't it? Particularly for people who might feel like, oh, I don't have a lot of money to start with.
Yes, absolutely. The author really emphasizes that you don't need some huge lump sum to begin.
Right.
Even starting small, maybe with something like €500 a month or whatever equivalent you can manage, can grow significantly over time, thanks to that power of compounding again.
It all adds up.
It does. And they share that their own journey, becoming a millionaire through investing, wasn't overnight. It was a decade-long process of learning, investing, failing, and growing.
Failing too. That's important to acknowledge.
Yeah, it makes it feel much more real, much more attainable for the average person, I think. It's not some secret formula only geniuses know.
It's about the process.
It's about the process, consistent effort, learning over time. The author's final thought is really empowering. If I can do it, so can you. The key is to start, stay disciplined, and let your money work for you.
Love that. So, okay, to bring it all together then, the core lessons from this deep dive into one person's successful investment journey seem to be: first, cultivate that patient, learning-oriented mindset.
Foundational.
Educate yourself on the fundamentals before you invest. Start investing, even if it's with small amounts, maybe through those SIPs and mutual funds.
Get the ball rolling.
Be consistent. Reinvest those dividends to really harness compounding. Resist the urge to time the market. Focus on time in the market. Stay invested.
Yep.
Diversify your investments to manage risk. Use automation and tracking tools to stay organized and efficient.
Keep it manageable.
And crucially, be aware of and actively avoid those common beginner mistakes,
Yeah.
like chasing hype or panic selling during market downturns.
Absolutely. Avoid those self-inflicted wounds.
And ultimately, building wealth through investing, as this article clearly shows, it's a marathon, isn't it? Not a sprint.
Totally. It requires patience, discipline, and a really long-term perspective.
Okay, so final thought for you listening. Considering that incredible power of compounding we've talked about, highlighted in our source today, what small, manageable step could you take, maybe even today? Maybe it's just researching a low-cost index fund or setting up that first recurring investment, even if it's just a small amount. What's one step that might have a surprisingly significant impact on your financial future, say, over the next decade or two?
Yeah, it's a great question to ponder. Starting is often the hardest part.
Definitely something to think about as you consider your own financial goals.